All right, let's dive into the latest financial results from DBS. Now, from an investor's perspective, this is a really fascinating story. We're talking about record profits, even while facing some serious economic headwinds. We're also seeing a huge jump in what they're paying out to shareholders and a very clear signal about what the bank expects for the future. So let's break it all down. Okay, right off the bat, let's get to the headline number. DBS posted a record-breaking profit before tax of 13.1 billion Singapore dollars for the full year. I mean, that is just a massive figure. It immediately tells you that something went very, very right for them in 2025.
And it's not just us saying it. The company's leadership feels the same way. The CEO's presentation really summed it up perfectly. A strong year for the franchise. You know, this really sets the stage for the big picture we're about to explore. A year that wasn't just defined by profit, but by some serious resilience.
But here's the thing. This record profit didn't just happen in a vacuum. Nope. The bank was up against some pretty significant challenges. So let's take a look at how DBS managed to navigate these economic headwinds.
This really lays out the core story of the year side by side. On one hand, the challenge was twofold. You had falling interest rates, which makes it much tougher for banks to make money, plus a stronger Singapore dollar. So what was their response? Well, they had a very deliberate strategy that focused on proactive balance sheet management. That's just a way of saying they carefully managed their assets and liabilities to lower risk. And they really pushed for growth in specific, high-performing areas.
Now, you probably hear this term rate headwinds thrown around a lot. So what does it actually mean for a bank like DBS? Well, to put it simply, when interest rates fall, the bank's margin, the difference between what it pays for funds and what it earns on loans, it gets squeezed. It's a fundamental challenge to profitability, and it was a major factor for them in 2025.
So how do they fight back against that pressure? Well, this slide shows a kind of three-pronged counterattack. First, they attracted a massive $64 billion in new deposits, the most in the bank's entire history. That gave them a huge, stable funding base to work with. Second, they grew their fee income by 18%, which shows they're not just relying on interest. And third, they saw a huge 29% jump in wealth management fees, tapping into what people are looking for right now. This just shows a brilliant and really successful pivot, proving they could thrive even with those intense rate pressures.
Okay, so record profits and smart strategies are great, but for any investor, it all boils down to one simple question. What does this mean for my returns? So let's shift gears and look at the dividends and see how all this success translated into real returns for shareholders.
And the answer is a big one. The total amount paid out in dividends for the year jumped by a whopping 38% compared to the year before. That's not just a small bump, that is a very strong signal of financial health and a real commitment to returning value to shareholders.
And to put that in more tangible terms, the total dividend for every single share held for the full financial year came out to $3.06. That's a concrete number that makes the year's success very, very real for anyone holding the stock.
Now, what I think is really interesting is how they actually structured the fourth quarter dividend. It totals 81 cents per share, so the final ordinary dividend got a nice little increase up to 66 cents. But on top of that, they added a brand new 15-cent capital return. This is basically the bank saying, you know what, we have so much excess capital and we're so confident in our stability that we're giving an extra bonus back to our shareholders. It's a really powerful statement.
But look, a credible analysis means we have to look at the whole picture. And while the full-year results were absolutely stellar, the story in the final quarter, well, it was a little more nuanced.
This table does a great job of showing that contrast. On the left, you've got the strong, positive growth for the full year. But look over on the right. The fourth quarter numbers show a year-over-year dip pretty much across the board. Profit before tax was down 6%, total income down 3%, and net profit was down 10%.
So what happened? Why was there such a disconnect between that amazing record year and the weaker final quarter?
Well, the reports give us three pretty clear reasons. First, those rate headwinds we talked about earlier, they were still applying pressure. Second, the comparison to the previous year was just plain tough, because Q4 of 2024 had some one-off gains that didn't happen again this year. And finally, tax expenses were simply higher. So having that context is absolutely essential to correctly interpreting those Q4 numbers. So, with the full story of 2025 in view, we come to the final and, let's be honest, the most important question for any investor. What's next? Let's take a look at the guidance for the year ahead.
Despite that softer fourth quarter, the overwhelming message coming from the board is one of confidence. And they aren't just saying it with words. Their actions and their future plans are really designed to back it up. And right here, this is the key takeaway for the future. The board has explicitly stated its plan to continue that new capital return dividend, that 15 cents per share per quarter, for the next 2 full financial years. Committing to this, barring any unforeseen circumstances, is a huge signal. It tells you they expect continued strong performance and are prioritizing sustained shareholder returns. It basically turns a one-off bonus into a forward-looking policy, and that's something investors love to see.
This content is intended to serve strictly and only as an informational, independent, objective summary of recent events, and should in no way be interpreted, construed, or relied upon by any party as inside information or financial advice.